still expecting, by the way, to wake up one morning and see gold up $200 from
I am
last
too.
sale to a new high, right? Like
Yeah.
something like that is going to happen. I don't know if a headline's going to drive it. I don't know if it's going to be, I don't know what it's going to be. I don't know if it's going to happen for no reason, but it feels
Yeah.
like it's coming.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a fantastic discussion lined up today that I am very excited about. There's been a lot of chatter of a major rotation that will take place from financial assets to hard assets, and that hard assets will be the place to be over the next decade. Recently, we've watched various hard assets such as cocoa, oil, and gold break through resistance and go on some substantial runs. Inflation is surprising most to the upside because of all of this and rising wages. And debt servicing costs are growing at breakneck pace. And now many believe that the Fed won't or even can't cut rates in 2024. To talk about all of this and more, we're fortunate to have with us Tony Greer, founder of TG Macro. Tony, thank you so much for joining us today.
Gary, thanks for having me on the show, man. How are you today?
I'm wonderful, and I'm super excited. I'm pumped.
Good.
All right, so let's begin with an intriguing comment that you wrote on your website that I want you to flesh out for us. You wrote, I believe that there's a massive opportunity in both the unprecedented situation in global markets and in the way financial news is consumed. Can you speak into both of those?
Yeah, that is an original quote on my website, which was really kind of the reason that I wanted to give the reason why I pivoted out of Wall Street and into content creation and writing a newsletter and managing a trading newsletter kind of thing like that. I was trying to skate where the puck was going with, obviously the trust in legacy media is imploding.
Totally.
And, the way Wall Street is functioning is sort of changing with that, where there's not as much of a need for every single portfolio manager and investor to read the Goldman Sachs report. There may be an entire hierarchy of reports, that he can read that are less expensive, easier to read, something that he can get his hands on that's at a institutional quality level. So it came along with kind of democratizing financial information. And, it came with the growth of, an entire massive population of people that are trading from home, both trading Bitcoin and trading stocks or whatever, kind of the way the world changed. There's people, the secular changes in the sort of economy, there's more people working from home, trading their own account. And so I try to really exploit that by going out on my own, which is something that I always wanted to do. And this is my second shot at sort of running my own business. And this one, knock on wood, has lasted a lot longer and seems a lot more sustainable.
That's awesome. Yeah. So, Tony, what mechanism or process do you use to analyze, follow, and make calls on the market?
Yeah, it's a good question. Since I started writing the newsletter and stopped working for Wall Street banks, I was able to take all of that time in my life that I got back and start following the market a lot more closely and the way I wanted to follow it. And the way that I do that is that I've got a spreadsheet that I've created that has all of the, kind of bucketed securities that I trade, from stock indices to commodities to cryptocurrency to stock sector ETFs. And I basically follow the closes and percentage moves in all of those securities on a daily, weekly, monthly, and quarterly and annual timeframes. So along the way, I'm doing all of those studies. So every day at the close, I'm taking a look and seeing what happened. I'm seeing what the major magnitude moves are and where that's taking the security technically. Every week at the end of the close, I'm looking at the same thing, looking for what the weekly story was. At the end of every month, I'm looking for the monthly story. What's going on? What's trending? What changed? And when I kind of do that overlay against the lens of very basic technical analysis, you're able to find markets that are trending. And that's kind of how I try to keep it simple and let the market speak to me and show me what markets are trending, rather than call it sort of, the old way that I used to trade, which was to sort of look at the world and figure out what it should look like and put your positions on accordingly. And then, wait for the world to go ahead and prove you right in all of those markets. When you realize that that is not the way to trade and make money, or to even approach markets if you're trying to trade for profits, you realize that there's a better way. And I feel that I've very organically grown into the better way, which has a lot to do with that process that I told you about. That, from following that process and writing about markets, and as you'll hear a lot of authors say, I write so that I know what I think. And to me, that's like the ultimate way of sort of clearing my brain and making sure that my thoughts are cohesive about markets and that they make sense, is by writing things down. And I started doing that a long, long time ago, before I had to write to anybody. And then I got the opportunity to cover a client on the West Coast that needed a little bit of an update in the morning. So I started writing about, what was going on, and kind of that writing of observing markets and writing and knowing what is driving markets is very much the sort of skill set that I'm trying to share with people, so that they can, start to figure out where to look in the morning when they subscribe to the newsletter and read it and see where I'm looking at taking risk and managing risk, et cetera, et cetera. I hope I didn't get too far ahead of the question.
No, not at all. And I really love the scientific approach, and I love the unbiased nature of the mindset. And I'm wondering, since you've kind of gravitated or, molded and melded this new way, which is probably not new anymore, but from the old training that you had, what kind of results are you seeing now versus before?
I'm crushing it, quite honestly.
That's awesome.
Yeah, it's very much the way you force yourself to put your cohesive and accountable views on paper, following the markets and having them speak to you on that regular basis forces you to listen to what they're saying, right? And it forces you to sort of wash out the bad ideas that you have. Like, if you think this market was going one way, and here you are doing the analysis, and on a daily, weekly, and monthly time frame, this thing is going the other way, you can no longer deny that. So your view now, your bad view, is out the window. It starts taking hold when you start seeing things go up every day, and then all of a sudden they put in a couple of weeks of rallying, and then you notice they're going a couple of months in a row. That gives you the opportunity to get in on a trend that might go for 10 years. And believe it or not, I've done things like that, where I've kind of started moving money towards things, had the trade work out, leave a trailing stop, and next thing you know, the security that we smartly engineered an entry into is off on a trend, and my trailing stop can do all the running it wants to keep up, and I can't catch the market anymore. And that's sort of the holy grail of the type of trade that I'm hunting down on a regular basis. So go ahead. Yeah.
Yeah. So I know that your background includes commodities, foreign exchange trading, metals, precious and base metals, and for several decades. Let's shift over to the markets. I'm excited to hear from your background here. In a recent interview that you did with Harris Kupperman, otherwise known as Cuppy, he stated that the current market reminds him of basically fall 1999 through Q1 of 2000, where like 10 or so names went up every day. Traders sold everything to raise cash to get into those names, leaving bargains everywhere, typically in value plays. Do you agree with Cuppy, and also see this market as basically a late stage .com, so to speak, frenzy, or comparable to another time? How do you see this current market?
Not at all. I don't agree with Cuppy at all. I love Cuppy like a brother, and he's literally one of my favorite people to talk about markets with. But I disagree vehemently with that view that this is any sort of analog towards a 2000 bubbly type of thing. Okay, when I When I think about that period of time, the one thing that I remember that stands out is that I was working at Goldman Sachs, and I remember that when you went out for drinks to a bar to meet other people in the business, you overheard 24 conversations about people talking about the tech stocks that they were long and getting rich on, right? Not one. You heard tickers coming out of every, from the bartender was telling you about the tickers that he was making money in. The coat check girl was in another ticker that she wanted to know if you knew anything about. And so that's the bubble type of thing that I felt in the .com era, right? To me, the analog is, I don't see any of that right now. I don't see anybody talking about the stocks that they're long or anything like that. If anything, I see a little bit of that dynamic in Bitcoin. A lot of young new millionaires that did a great job trading that, and that there seems like there's that type of optimism, blind optimism in that market right now, which is fine, and maybe they're all right. But to me, the analog is 94, 95, right? So if you want to talk about that for a minute, in 94, the Fed raised rates from 3% Fed funds to 6% Fed funds, right? We were slowing down a really overheating economy and a bit of inflation. In 94, the stock market was extremely volatile. It traded to the highs, the lows. It was all over the map. Ended the year down 1.5%, right? In 95, though, we found the peak of interest rates at 6% Fed funds, and they traded in a range from 4.5% or 4% to 6%, actually a little bit lower, 3.5% to 5.5% for the next 5 years. And after that, through that, that's when we had the .com tailwinds and Amazon, the birth of Amazon and things like that, and the mobile phone. And those tailwinds kept the market going in tech for years. So the market was thriving on the fact that rates were range bound and that there was this new tech craze. And so to me, this feels really similar, right? We found, the way inflation took off, right, with the Biden administration and the Ukraine operation and whatever you want to call it, $135 oil, that whole scenario. The Fed pulls its magic trick to get inflation down from 9% to 4%, right? Commodities are all sliding, et cetera, et cetera. So last year we went through that volatility and the market was, sideways to higher last year, but now we're coming out of it with a fresh breakout in the S&P, and we're seeing fresh breakouts to new all-time highs in sectors like energy and home builders, and we've got the AI tailwinds behind it. And I look at that scenario and I'm like, man, unless there's an interest rate shock, this move is totally sustainable, and I'm talking for years. So that's my view right now, and okay. I definitely disagree with Cuppy, but that's the way it goes.
Yeah, that's fine. So, Tony, the economy's been in this period of elevated inflation, like you just talked about, for several years, and doesn't seem to be waning. Actually, there's signs that it's reaccelerating, maybe even becoming the dominant factor. Are the markets in a melt-up scenario in conjunction with this high inflation? Is it now less about what you own, like value versus growth versus tech versus banks, and more that you just own something, anything?
You can make a really good case for a quote unquote everything rally right now, right? Which is why I'm pretty bullish the S&P, because it feels like you can have a scenario where, first we just had Nvidia go berserk, right? And lead the markets, the Mag 7, the big tech rally at the beginning of the year. That is all still intact. And what just happened last month is we had commodities and natural resources just wake up on a dime. There was the BCom, Bloomberg Commodities Index, was negative for 7 months in a row. And then in March, it was up 2.5%. So it made a serious statement, a big potential turnaround off of a flat bottom. I mean, the commodity sector has got a chance here.
CRB did too, didn't it?
Yes, exactly. And obviously you see what's going on with gold, right? We can talk about that whenever you want. This breakout to new all-time highs is ferocious. You see what's going on with oil. It's been a straight march from the range bottom at $70 to the last sale literally at 87, the new high as we speak.
It's amazing. And we're going to touch on both of those in detail.
Yeah. So it's like, I mean, the natural resources sector is waking up and banging pots and pans. And if you're not listening, you're going to be behind the eight ball in the next couple of months. I'll tell you that.
Yeah. 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 So do you expect market volatility to increase here soon? And if so, do you anticipate that kind of volatility will shake people out of some of the markets and maybe move them into safety? And safety, I mean, like bonds and gold. However, bonds doesn't seem to fit the bill today like in the past. So how do you see that playing out with volatility?
So volatility, we want to talk about S&P volatility, the VIX kind of thing, or
Yeah. Yeah.
broadly speaking?
Well,
Okay.
both. Yeah, both is fine.
Yeah. So, it feels like, put it this way, my radar is up because it was pretty clear yesterday that when Anthony Blinken said that Ukraine was going to inevitably join NATO, it looked like that caused the slide in stocks and the spike in gold and the commodity market to go, whoa, what the fuck did he just say?
Right.
Right. So like I feel like that went on yesterday, and that's the risk to the market, I suppose, right now, right? That fear headline risk, because it wasn't, that sell-off didn't come with any dramatic move in interest rates or the dollar, right? That wasn't a macro gyration. That was a fear trade. Everybody said, wait a minute, that was a scary headline that just came out. There was another Israel headline, and it was a fear pullback in the stock market.
And gold
So
seems to be continuing that today.
gold's printing a new high as you're talking right now
Exactly.
at 23 and a quarter, right? So
Yeah.
gold smells something, right? If
Yeah.
you don't see what gold smells, you're sleeping right now.
Exactly.
So let me get back to your point. The volatility, it feels like we're due now for a scenario where we just got a couple of months where CPI and PPI came in hot again.
Mm-hmm.
Right. So your point about it not going away is spot on. It is not, it stopped falling. That is for damn sure. And now
Right.
we've got this commodity rally that's, going to come out in the numbers soon. So there's going to be stuff like that comes back. So there's your upside risk in interest rates, right? A bond dislocation lower where the bond market has to respond to the commodity inflation and rates start flying again. And you get this natural resources rally like we saw in all of 2022. Right, where natural resources were higher, rates were higher, technology got body slammed, right? So that scenario is sort of the risk right now, and I don't think that happens. But you got to consider tech is vulnerable for a pullback,
Mm-hmm.
right? Like I said, the bull market
And not
is
as strong, because Apple's fallen off, and Nvidia seems to have leveled off around between 8 under 950 or whatever, and Tesla has fallen off. So it's weaker today compared to where it was.
Bingo. Things look very different than they looked just 6 months ago, right? If you would have said 6 months ago that Apple and Tesla and Nvidia are going to get beaten, or not Nvidia really, but Apple and Tesla are going to get
Right.
beaten up from here, people would have been like, what are you talking about? For what? So you're right. So that's the big sea change, is that Apple's on the way down. What it looks like to me is that the market is trading disco balls. The market's favorite stock forever was Apple, right? From the music to the phone and to the iPad and to whatever else. And now they're kind of, if you ask me, they ran out of magic tricks, right? They haven't invented anything or innovated in years. And AI is, I can tell them to draw a picture of me and Gary Boehm on the top of the Empire State Building, and we get a picture of me and you on the Empire State Building. Right. So there's the next new craze to me. And sort of, like you said, we've proven that got a little bit over its skis. Right. Nvidia's back observably off the highs, and it just overran too far. So we'll see what happens now. But my point is, it feels like we could have that type of thing where rates push the sort of higher end of the range with a natural resources rally. That puts a little bit of pressure on tech where it sort of struggles to perform. Maybe we get a little bit of realignment. But the most important thing for me, Gary, and to keep in my to sort of posture of my bullish S&P stance, is that the S&P is doing a great job right now sorting out winners and losers from a bullish perspective and like from a bull trend perspective. That's why I'm pretty confident in wanting to buy a dip. Like I would welcome a 10% dip from here into the 200-day moving average. Like that would be fine with me, because we are not facing an all asset class sell-off crash kind of thing, right? Commodity markets are going up. XLE, home builders, exploration and production. These are all trading at all-time highs right now, right? That is not bear market crash price action. So you kind of have to adjust your I don't know. I think you have to adjust your lens if you're looking for like a collapse of the stock market or something like that. That it's just kind of not a very, very low probability scenario in my book. So that's where
So do
we
you
are, and I don't want
think?
to get too far ahead. Yeah.
No, yeah, yeah. So do you think volatility that you anticipate coming is going to push people deeper into gold?
Yeah, I do. Yeah, I do. Gold. I mean, we can get to that right now. Like
Well,
I'm
we'll
on
we'll
the.
go deeper into gold. I'm just curious about the volatility aspect.
I don't think gold. Gold is doing what it's got to do. It's been really orderly, right? The breakout to new all time highs. I mean, I'm a little disappointed because we're going to talk about gold, Gary, whether you like it or not. All right. No, my point is like I'm a little disappointed because I'm still expecting, by the way, to wake up one morning and see gold up $200 from
I am
last
too.
sale to a new high, right? Like
Yeah.
something like that is going to happen. I don't know if a headline's going to drive it. I don't know if it's going to be, I don't know what it's going to be. I don't know if it's going to happen for no reason, but it feels
Yeah,
like it's coming.
it does.
So, yeah. So
More
the
than
sort of
more than one of
yeah,
those.
we could have a little bit of a dot shot if you remember
Yeah.
the old commodity term for limit up for several days in a row, where the chart just has a couple of dots on it.
Yeah.
Right. It would
So
be cool
let
to see
me
something like
ask
that.
you about debt. So debt is and the Fed debt is close to 35 trillion. There's something like 7 trillion in debt maturing this year, plus our deficit. So let's just call it 10 trillion. If rates stay around 5.25 where they are today, then interest on the debt is projected to approach 2 trillion by the end of next year. 2 trillion. That's if rates stay where they are, which don't seem to be restrictive at all. Of course, this number gets bigger if they raise rates to a more restrictive territory. So my question is the Fed boxed in here? It doesn't seem like they can raise rates because of the debt servicing issue. It doesn't seem like they can lower rates because they already aren't restrictive enough. Keeping them here, everything's inflating. What's your perspective on that?
Gary, my perspective on the Fed is one that's pretty permanent, right? And that is that they are never boxed in. I don't buy into that at all. I
Okay.
feel like if you control the narrative and if you control money supply, you ain't boxed in as shit.
Okay.
And it's just the way that I've seen the Federal Reserve. I used to wanted to be a young whippersnapper in my 20s that read the journal and threw eggs at the Federal Reserve all day long. And, I have to say that in my years of experience trading through various crises like the long-term capital and great financial crisis and being in big institutional bank seats for those trades, I'm amazed at what the Fed is able to do, quite honestly. Right. I mean, the great financial crisis was like a sight to observe. Like, if you don't think that they can clean up every mess on the street, you better think again after the
So
great financial
where
crisis.
do you see rates going? Do you see them being range bound like you spoke about earlier, 94, 95 timeframe?
I do, because this is what I think. I think that inflation is going to be persistent and nagging, right? Well, like you mentioned before, you mentioned the deficit at what's the number, 36 trillion
It's
or
yeah,
something.
35, 30. I mean, it's high, whatever it is.
Whatever it is, you know what correlated with the gold breakout on a timing perspective? When the word got around that our deficit was going up at $1 trillion every 100 days, to me, that
Amazing.
was a crystal clear overlay of gold going, oh, no, 2080, forget that range top, we're gone, right? Like
Yeah.
$1 trillion every 100 days. Are you mad? You know what I mean? On top of that, and you take a look at the border, and that's all, all the people, I don't want to get political, but everybody coming through the border is going to get paid for by the US Gov, right? By our tax dollars.
So printing,
I
printing, printing, printing.
right, I feel like the market's got to be calculating a little bit of that, right? They don't talk about the cost of the invasion on legacy media, right? All you hear is that here they come over the border, and guess what? They're in your town, and guess what? They're in New York City, and they're getting cash cards that you're paying for.
Yeah.
So how does the world not say more inflation, more printing, more, the whole thing, So that's why, to me, this gold breakout is a sort of upsize if you got them, and don't be very quick to let any of it go. Like, you're going to need this stuff in the next 5 years
Yeah.
in the
So
portfolio. I mean, yeah.
Yeah. No, I understand. So the following was shared from your Navigator newsletter, and I found it really interesting, Tony. If you know that the CPI was going back to 6% or higher, what would you do? short the bleep out of bonds, buy commodities, sell the dollar, buy emerging markets, sell stocks, buy gold. Can you speak into that statement?
Yeah, that was me quoting Jared Dillian, if you know it or not. And you should speak with him if you haven't done so lately. He's got some really good views on how monetization is driving gold, or future monetization is driving gold. And that's his story, so I'm not going to steal it. Wait, where were we going?
I just wanted you to comment on that statement.
Oh, yes, that statement. So that was me sort of saying that Jared is picking up on the very same thing that I'm picking up on right now. What's the risk here in the markets is if rates rip higher. And if rates rip higher, what is going to happen, right? Like that's the next leg of the trade. You would think is if rates are going to go higher here, you're going to see tech pull back. You're going to see all the interest rate sensitive stuff in the markets pull back. You're going to see natural resources continue to rally. And that was sort of the follow through trade. So it's kind of like that's what I was kind of posturing in the newsletter, that I was getting the signal from the market. And I was like, by the way, look who else is getting the same exact signal, because this is what Jared said. It's my view in a different form. Right. So it was just kind of it was kind of putting a mirror image of the way he was looking at it versus the way I was looking at it, because it's very potent sometimes when our views line up, because we have a lot of people that read both of our newsletters and tell me that.
So Tony, so basically what you outlined there is basically you believe that inflation's going back up to 6% or higher, that in that environment you should be shorting bonds, buying commodities, selling the dollar, selling stocks, buying gold.
Yeah. I don't have a view on the dollar or whatever, but the other stuff, yes. And my point being that what's going to happen next is the Fed is going to combat that and come out at some point guns blazing against the rising inflation. They're going to wait until it shows up in the data. But the way I see it playing out, Gary, picture that we had the high end inflation CPI print at 9%, right? Whatever it was, CPI spikes to 9%. Fed just battles it back down. We sell the SPR, right? We get the whole deflation story going. We talk a mile down the road about all the rate cuts that are coming, right? The market prices in the deflationary bomb. Get CPI down to 4.5%, 4%, 3%, whatever it is in the headlines, right? Now we're obviously going to see a pickup back, another rally in CPI. The Fed is not going to let it get it near 9%. Right. So as it starts to show its head at 5 and 6% in the market, potentially, the Fed is going to come out and absolutely devastate the inflation idea again.
How are they going to do that?
I don't know. I don't have a crystal ball.
Okay.
But you know as well as I do that they're going to have to, because you're the one that's following the interest expense closer than I am. Right. So if they're going to let rates fly, it's going to cost them. Right. So what are they going to have to do? Figure out how to get it back down. I don't know if they're going to sell the last 17 million barrels in the SPR, but they're going to do something.
Okay. All right.
That's my idea.
Yeah. No, and I love it. So in prior cycles, buying treasury bonds when stocks were under pressure was usually a very good idea. It seems as if in this cycle, it's the opposite. Are investors not coming to terms with this new regime? And what opportunity does that present those who understand this change that's taking place?
Well, the market has spoken, Gary. We're in a 3-year bear market in bonds, right? That's not over just yet, right? And so that's the market voting with its feet in treasuries, right? We know that there were a lot of foreign sellers of treasury bonds over the last several years. That's why they're lower and rates are higher. You would imagine that, what you put it this way, when you put the headlines next to each other, central banks selling U.S. treasuries, next headline, central banks buying gold, it's pretty clear what they're doing with the dollars they're collecting from the treasury sales, right? And smartly diversifying their balance sheets in the vault, right? So if they're doing that and that's going to continue, which seems like it certainly can, then to me, gold is the best trade on the board. And I forgot what the main point of this question was.
Yeah, it was really are investors not yet coming to terms with the new regime, and because they're not coming to terms with it, does that create an opportunity for those who understand what's taking place?
Yeah, so it feels like, what, like I said, the bear market in treasuries, it seems like that's, the part of the big sea change. Whether the bear market continues, I agree that that's the way the asset flow is going, right?
Okay. Okay.
Yeah.
So Tony, let's shift over to gold here. In the
Yep.
in the early 2000s, as gold was beginning to move and inflation was an issue, Fed Chair Alan Greenspan essentially stated that he used gold as a metric to gauge inflation and Fed policy. So $400 gold was the number that he was watching. And if it exceeded 400, basically policy was not restrictive enough. He could tighten the rates and policy. And if price was under 400, then policy was sufficiently restrictive. Today, gold's broken out. But as we have already spoken about, if Powell tries to raise rates with 35 plus trillion in debt, he'll crowd out other expenditures. So if he keeps policy where it is, inflation's going to continue to push higher. Tony, does it matter that Powell seemingly can not contain gold here under 2000 like it has been range bound the last 4 years? Similar to how it mattered to Greenspan back when gold was, under 400?
Man, that's a good question, Gary.
When you subscribe, we want to give you a free gift. It's a report that we wrote based on an important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe. It's free, and get the free gift.